Let's get straight into the economic news because there is a lot to get through this week, including the RBA board meeting tomorrow, GDP numbers on Wednesday, and then RBA Governor Philip Lowe's final speech as leader on Thursday. Joining me now on set is Warren Hogan, Chief Economic Advisor at Judo Bank. Warren, let's start with the RBA board meeting tomorrow. You're expecting rates will be on hold at 4.1%?
Yeah, I think that's a pretty universal view. The data since their last meeting has all been very friendly. Good news, really, on the inflation front. The wages number a few weeks ago was modest. And, of course, last week's CPI came in a little weaker than expected. So no one's expecting a move. And, of course, this opens the question, and the markets are debating this, about whether the next move in rates is down. And I think that's what's important about tomorrow is the statement, because I think it'll be a risky move from the RBA to start playing to that talk of rate cuts.
Right.
Because there's a long way to go on this, and they need to keep the tightening bias firmly alive in the market's mind.
I mean, how far away is the market expecting rates may start to come down? Are we talking 12 months?
Yeah, no, it's actually the money markets aren't pricing much in the way of rate cuts. You're getting a few economists talking about it, but of course, as you look, out 12 months and beyond, the bias is for rates to come down, and that of course makes sense. Because after a while of having rates elevated, there should be some relief. But I think there is still a risk that there are rate hikes out there. And of course, even if there's not, this isn't a cycle where they've jammed rates up to slow the economy aggressively. They're trying for this narrow path, but that implies higher for longer. So I think the best we can hope for is that rates stay at this level for at least 12 months.
It's also Phil Lowe's last monetary policy meeting as head of the RBA. Then he speaks on Thursday with some farewell remarks. Do you think he's going to lob any grenades at the government on his way out?
Look, I don't know. I mean, he clearly wanted his term extended and didn't get that. I think he's been, there were missteps in the pandemic, but he's been treated pretty harshly by the broader community, and the politicians haven't really defended him in the last year through this hiking cycle. I think people shouldn't lose sight of the fact that our rates are at 4.1. New Zealand's are at 5.5. The US is at 5.5. They're all higher. He's done everything he can to minimise these rate hikes, and it will be interesting to see what he says. I don't think he's going to avoid a few parting shots, and it will be really interesting.
He has talked about productivity a lot in Australia being at record lows, and how government really needs to pick that up.
Yeah, and I'm sure that'll be part of the Anika Foundation remarks later in the week. And I think also there's a good chance he'll leave with a bit of a hawkish message and remind the market that this hiking cycle, while it'd be great to think it's over, it's premature to make that call.
Wednesday, we've also got GDP for the June quarter. What are you anticipating there? A
soft number in terms of overall GDP, as per the market. Market's expecting, I think, a 0.3 increase. The annual rate will fall to 1.5, 1.7 from 2.3.
That doesn't sound like much.
No, the slowdown's happened. I mean, this is the thing. We've got the soft landing playing out now. The big adjustment in rates has had their desired effect. It's slowed spending. We've got capacity constraints in certain parts of the economy as well. So the question really is the level of rates and is the settings for fiscal policy and these wages and industrial relations decisions and so forth going to keep the economy soft enough to get inflation all the way down to sub 3% as per the RBA's forecast and target? And I think, we're not going to get much insight on that. But I think the message that this economy is already slowed and doesn't look like it's falling off a cliff. All the data last week, business investment, new mortgages, the retail numbers, they all show that the economy is resilient. Yeah. So I think the GDP numbers should remind people that we've got this slowdown that's already happened, but it has to be maintained well into next year to get the inflation down.
One thing we saw in the March quarter was the household savings ratio really start to fall away. People starting to spend their savings. Do you think that's a trend that's probably going to continue in the June quarter?
It's a really important part of the GDP numbers. We get that information. We get some numbers on services spending, which we don't have otherwise. And I think that dynamic is critical, and I think it will happen. The reality is we built up a real war chest in our household sector, not evenly distributed. It's sitting with wealthier people. It's sitting with older people. But there will continue to be a drawdown on that. We're seeing it with, European holidays and so forth. This is money that was saved that is now being spent. And I think we'll get some more insights into it. The desired rate of savings by Australians is going to be It's going to be lower than that because they're spending their buffers. So we're going to see some quite low household savings rate. But of course, what that means is they're spending. And that means resilience in the economy. And it opens this question of whether the RBA has more to do.
Warren, I think we're pretty much out of time, but I know China are also releasing some inflation numbers later this week, and we might also see signs of deflation there.
Yeah, well, we got deflation last time. This is the big story. Is China in a bit of trouble? A debt deflation? We know they got debt problems. If prices start falling, it's a real issue. And of course, it also opens the question, is deflation in China going to slow the inflation around the rest of the world?
Warren Hogan, thanks for your time.
Thanks, Ed.